Picture this. You have a credit card in your wallet. When you swipe it, three things happen in milliseconds. The merchant's bank gets paid, your bank gets paid a small fee, and Visa or MasterCard, the network in the middle, collects a toll on every single transaction. Now imagine you're Capital One, and you just bought the only major card network not owned by Visa or MasterCard. You have a credit card in 350 million American wallets, and starting today, you get to keep the toll. That is the bet Richard Fairbank just made, and it's the reason that despite a slight earnings miss this quarter, some of Wall Street's smartest money is banging the table on this stock.
It's one of the most audacious strategic bets in financial services in a decade. The Discover acquisition closed in May 2025, and Q1 2026 is the first full earnings quarter where you can start to see what the combined company looks like. EPS came in at $4.42 versus $4.50 expected, a miss of 1.8%. Net revenue of $15.2 billion also fell slightly short, and yet JP Morgan upgraded this stock 12 days before the print.
Welcome to Charged Alpha. I'm Hudson Thomas, here with Lana Chen. Today we're breaking down Capital One Financial, ticker COF. This is a company in the middle of transforming itself from a card issuer into a card network. And the question is whether the market is pricing that transformation correctly. Let's find out. Capital One was born in 1988, not as a bank, but as an idea. Richard Fairbank and Nigel Morris were consultants who believed that credit card marketing was a data science problem that the industry was solving with gut instinct and cocktail parties. They convinced Signet Banking Corporation in Virginia to let them test the hypothesis, built a card business inside Signet, and eventually spun it out as Capital One Financial Corporation, taking it public in 1994. Today, the company is headquartered in McLean, Virginia, and employs over 76,000 people, with total assets now approaching $670 billion, a number that includes the Discover portfolio.
The business has three segments. Credit card is the engine. Domestic and international card lending is where most of the revenue and most of the risk live. Consumer banking is the deposit and auto loan franchise. Capital One built its online bank early and has one of the largest direct deposit bases in the country. And commercial banking handles middle market lending, commercial real estate, and treasury services. Those three segments are what Capital One was before May 2025. After May 2025, there's a fourth dimension that doesn't fit neatly in a segment, the Discover Payments Network.
And that network is the whole thesis. Before this deal, Capital One paid Visa and MasterCard a fee every time one of its cardholders swiped. Post-deal, it owns the Discover Network, a closed-loop payment rail that competes directly with Visa and MasterCard. American Express has had this model for decades and gets a premium valuation because of it. Now Capital One has it too.
The end markets span everyday consumer spending, dining, travel, retail, gas, healthcare, plus auto loans and commercial real estate. The why now story for COF right now is really the integration story. This is the first full year of operating the combined company, and every quarter the market is asking the same question. Is the Discover integration on track, or is it more complex and expensive than projected? Q1 2026 gave a partial answer, but only partial.
Richard Fairbank is one of the most unusual CEOs in American banking. He's a co-founder who has been running this company for 37 years. He studied economics and business at Stanford, became a management consultant, and then had the audacity to tell a bank that their entire credit card operation was wrong and he could fix it with data. The fact that it worked and that he's still there is the story of his tenure.
What's interesting about Fairbank's leadership style is that he never came up through traditional banking. He thinks like an engineer who wanders into finance. The entire Capital One model, using information asymmetry and statistical underwriting to find profitable credit card customers that other banks turned down, is a product of that engineering mindset applied to a relationship business. That's why analysts who know him well tend to be bullish on the Discover bet. He has a track record of making unconventional strategic calls that pay off over a long time horizon.
The Discover acquisition is the capstone bet of his career. If it works, If Capital One can route meaningful card volume through the Discover network and reduce its dependency on Visa and MasterCard, the economic model changes permanently. The question heading into Q2 2026 is whether a quarter of slight misses signals something structural or just the normal noise of integrating two massive financial institutions.
Let me take you through the Q1 to 2026 financial picture. Starting with valuation, Capital One trades at $202.50 per share, with a market cap of about $125.9 billion. Now, the trailing PE is 44.6 times, which sounds alarming until you understand why. Q2 2025 included a massive charge related to the Discover acquisition closing costs, which crushed earnings for that quarter. Strip that out, and the more meaningful number is the forward PE on 2026 consensus estimates, which is 10.1 times. That is cheap for a company with a payments network on its balance sheet.
So the trailing number is distorted by the deal.
Completely. The price-to-book ratio is where the real signal is. At 0.96 times book value, below 1, Capital One is trading below its own stated asset value. Book value per share is $210 against a stock price of $202.50. For context, American Express, which has owned its closed-loop network for decades, trades at 3.5 times book. That gap, between 0.96 and 3.5, is what the bull case is betting will close as the Discover network thesis plays out.
What about the income statement?
Q1 to 2026 net revenue was $15.23 billion, against an estimate of $15.36 billion, a miss of 0.8%. The net interest income line was approximately $8.1 billion for the quarter, reflecting the full Discover loan portfolio. Net income for the quarter was roughly $1.45 billion, translating to $4.42 per diluted share, against the $4.50 estimate. That is a miss of 1.8%. Close, but a miss nonetheless.
And this is the second consecutive quarter of slight misses.
Q4 2025 was also a miss, 386 versus 414 estimated, though Q3 2025 was a major beat, 595 versus 449, largely because the Discover integration came in more efficiently than expected in the first full combined quarter. On the balance sheet, total assets are $669 billion, total equity is $113.6 billion, and the company is in a net cash position, cash of $57.4 billion versus total debt of $51 billion. Debt to equity is a conservative 0.45 times. Overall, Capital One's financial health is watchful. The balance sheet is enormous and leverage is manageable, but forward earnings estimates carry meaningful uncertainty around integration execution, consumer credit normalization, and network adoption pace.
The analyst picture for Capital One is unusually bullish. 27 analysts cover the stock, with 20 buys, 6 holds, and just 1 sell. The average price target is around $242. That's about 19.5% upside from current levels. The range runs from $190 on the bear end to $290 at the high end.
The notable calls heading into this print are important to understand. Morgan Stanley maintained their overweight on April 16th, just 5 days before the earnings release, citing the Discover network synergy ramp as a multi-year catalyst. Goldman Sachs maintained buy on April 7th, flagging that COF's at a discount to peers despite a superior long-run growth profile. And Wells Fargo maintained overweight on April 9th, noting that integration synergies were tracking ahead of initial guidance.
But the most striking call was JP Morgan's.
JP Morgan upgraded Capital One from neutral to overweight on April 9th, 12 days before the Q1 print. That is a bold move. The explicit rationale was the combination of network economics that the market is not yet pricing in and the PB ratio below 1 as a margin of safety. Essentially, they argued that even if the network thesis takes years to play out, you're not paying up for it. You're getting it for free because the stock is below book. That kind of valuation floor argument from a major bank right before earnings set a high bar for the Q1 print.
And then Capital One slightly missed anyway, so what's the read?
The read is that the stock didn't fall off a cliff, which tells you the miss was already being partially discounted. The street is patient on this one because the integration timeline is measured in years, not quarters.
Let me make the bull case for Capital One. First, the network. American Express has been a closed-loop network operator for decades, and it trades at 3.5 times book value. Capital One just bought that same structural advantage at 0.96 times book. If the Discover Network thesis is even half right, that gap does not persist. Second, the valuation math. 10 times forward earnings for a company that owns a payments network is historically cheap. The market is pricing in significant execution risk, which means the upside is front-loaded if execution delivers. Third, consumer credit quality has held better than feared. Capital One's data science advantage has consistently meant lower losses than peers through cycles. Fourth, the JP Morgan upgrade argument. At below book value, you have a floor. You're not betting everything on network ramp. You also own the underlying asset value. And fifth, synergy tracking is ahead of schedule. Management's initial targets may prove conservative.
Now for the bear case, and it starts with credit. Capital One has substantial exposure to subprime and near-prime credit card borrowers, the consumers who are most sensitive to elevated interest rates and a softening job market. Net charge-off rates have risen materially from their post-pandemic lows. If consumer credit stress intensifies, the loan loss reserve build could consume all of the earnings recovery the street is modeling for H2 2026. Second concern, integration complexity. Merging two large card systems, two customer service organizations, and two risk models is operationally demanding. History shows these integrations almost always take longer and cost more than projected. Third, the TTM/PE of 44 times is a distorted number, but it reflects a real fact, which is that earnings have been extremely volatile. The Discover acquisition brought enormous short-term accounting noise that makes it genuinely hard to model. Fourth, regulatory risk. The CFPB has been aggressive on credit card late fees and interchange rules. Any enforcement actions or regulatory constraints on Capital One's ability to price risk could erode the underwriting edge that justifies the premium. And finally, the Discover Network ramp is a thesis, not yet a reality. Merchant adoption takes years, and the revenue benefit is not yet in the income statement. Bulls are paying for a future that has not arrived.
How does Capital One stack up against peers? And for a bank, the right lens is price to book, not price to sales. Book value is the anchor for bank valuation because it represents the net asset value of the loan portfolio and other assets. It is as close to intrinsic value as banks get. On that basis, Capital One at 0.96 times book is trading below its own stated worth. The closest peer that makes the comparison most vivid is American Express.
American Express trades at 3.5 times book. It runs a closed-loop network, the same structural advantage Capital One just acquired through Discover. The gap between 0.96 and 3.5 is the entire Discover thesis spelled out in two numbers. Now, it's fair to note that American Express has been running its network for decades and has merchant penetration and brand recognition that Discover does not yet match. The ramp from 0.96 to something meaningful will take years and execution. But the direction of the argument is clear.
What about JP Morgan Chase?
JP Morgan trades at about 1.92 times book, so below American Express but well above Capital One. JP Morgan has no closed-loop network, but it has unmatched scale, investment banking revenue, and a fortress balance sheet that commands a premium. Then there's Synchrony Financial, a pure credit card lender with no network, trading at 0.71 times book. Synchrony makes Capital One look moderately valued, and it shows you what the market assigns to a card issuer without network economics. The bull case is that Capital One should be closer to American Express than Synchrony. The bear case is that it stays closer to Synchrony until the network proof points arrive.
On the options side, we don't have specific put-call ratio or implied volatility data for this episode. What we can tell you is that Capital One carries a beta of 1.14. The market treats it as a moderately elevated risk financial. With the Discover integration as an ongoing narrative and a slight earnings miss on the tape, options activity around this print likely reflected elevated uncertainty about integration timing and consumer credit normalization.
The fact that the stock held up despite the miss is informative. When a company misses estimates and the stock doesn't fall, it often means that options traders had already priced in the downside scenario and the actual result was better than the worst case they were hedging against. That kind of resilience in a slightly miss environment is a signal worth noting. It suggests the underlying bid for the integration thesis is real.
On insider activity, detailed transaction data wasn't available from our source this episode. What we can offer is context. Richard Fairbank has historically held a significant personal stake in the company as co-founder. He manages sales through pre-scheduled 10b5-1 trading plans, which is standard practice for executives with large concentrated positions. No unusual insider buying or selling was reported around this earnings print.
The co-founder alignment is worth noting. Fairbank built this company from scratch and has been running it for 37 years. That kind of skin in the game doesn't make the Discover thesis right, but it does mean the CEO's personal incentive is very much aligned with the long-run shareholder outcome. He doesn't win unless the network bet works.
The key risks to watch for Capital One going forward. Number 1 is consumer credit quality. Net charge-off rates on the combined credit card portfolio are the single most important metric. If charge-offs rise beyond the current consensus expectation, Capital One will need to build loan loss reserves, and that hits earnings immediately. Watch the quarterly charge-off disclosure very carefully.
Number 2 is Discover network adoption. The bull case depends on routing card transactions through Discover instead of Visa and MasterCard, and that requires merchant adoption, which takes years. Every quarterly earnings call, listen for specific volume metrics. What percentage of Capital One card transactions are running on Discover rails? That number will be the scorecard for the network thesis. Number 3 is integration execution. Technology systems, credit models, and customer service for 2 large card portfolios need to merge without service disruption. Number 4 is interest rate sensitivity. Capital One earns more when rates are high, but high rates also stress borrowers. And number 5 is regulatory risk. The CFPB and OCC have both signaled increased scrutiny of large bank card operations, including late fee caps and interchange rules.
So what's the bottom line on Capital One? This is a company in the middle of the most transformative deal in its history. The Discover acquisition made Capital One the largest credit card issuer in the U.S. by loan volume and gave it ownership of a payment network that could, over time, fundamentally change how much of each card transaction it keeps. Q1 2026 showed a slight earnings miss, 442 versus 450 expected, net revenue of 15.2 versus 15.4 billion. But the stock held up because the market is playing a longer game.
At 10.1 times forward earnings and 0.96 times book value, Capital One is not priced for optimism. It is priced for skepticism. And that skepticism has a specific shape. The market believes the Discover integration will be messy, expensive, and slower than management suggests. If management is right, and if Fairbank's track record of unconventional bets paying off continues, then this is significantly undervalued. If integration falters or consumer credit deteriorates, the skeptics will be right, and the stock has further to fall. The key metric to watch: the net charge-off rate on the combined credit card portfolio. That single number tells you whether the integration is proceeding cleanly and whether the consumer is holding up under elevated rates.
We'll leave you with a line from Richard Fairbank himself. He once said, "We set out to build something a little bit like a venture within a bank, a business that was built not on relationships, but on information and analysis." That was 1988. 37 years later, he's running a company with $669 billion in assets and a payment network with ambitions to compete with Visa and MasterCard. That's a long-run bet. That's always been his game.
And the market is asking, is the Discover chapter the same kind of bet? Data-driven, unconventional, and right in the end? Or is this the first overreach of a remarkable career? We don't know yet, but the valuation says you're not paying much to find out.
That's going to do it for this episode of Charged Alpha, your deep dive into Capital One Financial Corporation, ticker COF. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.